This may be the most important chart to understand today. Hidden inside the bond funds of millions of American 401k plans is a brand new $14 billion experiment that almost no one is talking about. PIMCO is now managing the debt for a single AI data center project in Michigan, and these bonds are quietly migrating into the same retirement portfolios you trust to fund your life after work. To put this in perspective, this is the fastest migration of speculative debt into mainstream retirement accounts since the year 2006. The project is a 575-acre hyperscale campus in Saline Township, Michigan, anchored by Oracle to provide compute capacity for OpenAI. The total cost has been revised up to $16.3 billion, with PIMCO providing approximately $14 billion in debt financing through 144A securities. These are privately placed bonds with a 19.5-year maturity, which essentially means they were never built for ordinary retail investors to hold. But here is the structural problem. Major bond indices, including the ICE BofA US High Yield Index and the Bloomberg Global Aggregate, explicitly include 144A securities in their composition. So any 401k bond fund or target date fund that tracks these indices is now structurally exposed to long-duration single-tenant AI infrastructure debt. And this is not happening in isolation. Just this month, CoreWeave issued $1.75 billion in 9.75% senior notes on April 14th, then turned around 2 days later and priced another $1 billion of the same notes. Morningstar projects. CoreWeave's total debt could reach $40 billion by the end of 2026, and the company is currently spending $2.60 in capex for every $1 of new revenue. Jamie Dimon cited $725 billion in projected AI capital spending across just 5 hyperscalers for 2026, up from $450 billion the year before. That is a number that exceeds the entire GDP of Vietnam, financed predominantly through credit instruments that are now being absorbed by retirement bond funds. Now, the optimistic interpretation is that the underwriters know what they are doing and that AI infrastructure is the new electricity. The reality is that JPMorgan just made a quiet move that completely contradicts that view. In April 2026, JPMorgan began restricting lending tied to software companies and proactively marked down the collateral on certain private credit loan pools. Software currently represents approximately 25% of all private credit loan portfolios, the single largest sector concentration in the industry. David Solomon at Goldman Sachs warned in his March 2026 shareholder letter that the credit cycle has not been repealed, specifically flagging exposure to software companies that may be negatively affected by AI. And in his April letter, Jamie Dimon said, "When you see one cockroach, there's probably more, and that losses on leveraged lending will be higher than people expect." When the largest player at the table folds while smaller players keep buying, history tells us that you should already be standing up because the cracks are already showing. Fitch's privately monitored ratings universe just posted a 9.2% default rate for full year 2025, a record high, and more than double the 4.5% default rate of public syndicated loans. Smaller borrowers under $25 million in EBITDA are already defaulting at 15.8%. In Q1 2026 alone, investors filed redemption requests of approximately $20 billion across the private credit complex. Blackstone's BlackRock received $3.7 billion in withdrawal requests and was forced to inject $400 million of internal capital, including $150 million from senior executives, just to avoid a hard gate. BlackRock gated its $26 billion H-Lend fund. Apollo honored only 45 cents on the dollar, and Blue Owl permanently froze redemptions on OBDC2. Blackstone shares have fallen roughly 45% from their 52-week highs, and Blue Owl is down approximately 40% year-to-date. This is the exact same playbook we saw in 2006 and 2007, when complex mortgage-backed securities migrated from institutional desks into mainstream bond funds, and by the time retail savers understood what they owned, prices had collapsed by 30 to 50%. History may not repeat, but it certainly rhymes. Now, if the Federal Reserve aggressively cuts rates back towards zero, and the AI revenue ramp materializes faster than the debt service obligations, this entire risk could potentially be deferred. But with the Fed funds rate still sitting at 3.5 to 3.75%, and with hyperscaler capex committed at $725 billion, that scenario is looking increasingly improbable. This is exactly where we are shifting our attention. Capital is already rotating out of synthetic credit instruments and into hard, scarce, real economy assets. Gold has reached new all-time highs of $5,593 per ounce as the US dollar continues to lose purchasing power against a $1.347 trillion annual borrowing program. Cameco shares are up 51% year to date, and Energy Fuels is up 42.6% as the global uranium market faces a structural deficit of roughly £31 million against rising AI-driven nuclear demand. Copper continues to face structural supply deficits while electrification and grid expansion accelerate. These are the bottlenecks of the most tightly supplied markets on Earth, and they sit at the exact intersection of the AI energy build-out and the credit rotation. The migration of $14 billion in speculative AI infrastructure debt into mainstream retirement portfolios is not a small story. It is a generational warning. JPMorgan is pulling back, default rates are climbing, software underwriting assumptions are collapsing, and the smart money is already rotating into hard assets like uranium, copper, and gold. The question is not whether this resolves badly. The question is whether you are positioned on the right side of the rotation before the rest of the market wakes up. Thank you for watching.